Welcome to Bloomberg Technology. I'm Emily Chang in San Francisco. Stocks jumping today to new highs, but not driven by Apple, Tesla, or Zoom. A sign of confidence returning to the broader markets. But still big news in tech IPOs. Airbnb rebuffed a merger offer by the activist investor Bill Ackman, choosing instead the traditional route to IPO. Meantime, Palantir set a September 9th date for its investor presentation, the data mining company pursuing a direct listing. And the dating app Bumble is preparing for a public offering that could come as early as the start of next year. Also, reports that the CDC has notified public health officials in all 50 states and 5 large cities to prepare to distribute a coronavirus vaccine to healthcare workers and other high-risk groups as soon as late October or early November. This all raising concerns about the politicization of the timing. Of course, the presidential election is November 3rd. Let's see how these and other stories are playing out with the markets today with our Abigail Doolittle in New York. So obviously, Abigail, stocks at record highs, but mixed messages beneath the surface. What are you reading in those messages?
You know, it was a very exciting day, Emily, because at the beginning of the day, it felt as though we might see a pretty decent decline. At one point, the NASDAQ 100 was down by 1%. But at the end of the day, big gains, including for that NASDAQ 100, the S&P 500 gaining 1.5%, and perhaps those vaccine hopes. But as for those mixed messages, there are some nuances, including the fact that the mega caps, you were mentioning Apple and Tesla being down on the day, that New York FANG index that seems to rise day after day, up just fractionally today. And yesterday we were talking about bonds as a signal of caution. Bonds rallying yesterday, bonds rallying again today. And because of that, the best sector for the S&P 500 wasn't tech. It wasn't one of the cyclical sectors that folks would like to see. It was utilities, a true defense sector, up 3.1% because those dividends look more attractive relative to to yields on the day. So, a risk on day, but there were some nuances to keep watching as we push forward. If bonds keep rallying, that would be worrisome. But one sector that was truly on fire, Emily, sort of taking over for the FANGs on the day, chips. The stocks up nearly 3%, and this had a lot to do with NVIDIA. Yesterday, as you know, they revealed some new gaming chips. Street's super bullish, lots of price targets raised, including a Credit Suisse to 620 from 530, RBC benchmark. So analysts like this a lot. They think these chips are great. The pricing is attractive, and that seemed to set off, this big buying wave for chips on the day. So that certainly helped.
But a selling wave when it came to Apple, Tesla, Zoom, all ending the day down. Of course, as we've discussed this week, a big run up in all of those companies, Tesla and Apple, with their stock splits. Tesla, we're preparing for them to possibly be added to the S&P 500 any day now. What do you make of the fact that all of those names that investors have been so optimistic about were down?
I think that today's move was something that a lot of folks, traders, investors have been waiting for, because how long can these stocks go parabolically higher? So today they came back to earth to some degree, at least for Tesla on the news that Bally Gifford reduced their stake to a little bit over 4% from above close to 8%. So that's a pretty significant reduction, really taking profits. Apple down 2% at the lows, Emily. Apple was down 5.4% at that point, on pace for its worst day since March, on not a lot of news. We were talking about the possibility of technical selling, and Matt Maley was on your show earlier this week talking about that. We saw some of that today, and that may continue. Some technical damage was done today. As for some of the other recent high flyers, Zoom yesterday, unbelievable, up 41%. Today, not so much, down 7.5%. Same deal with DocuSign. They report tomorrow after the bell, or it could be before the bell. They report tomorrow. Analysts are pretty optimistic about that report, but some of these companies, notably Zoom and DocuSign, they've IPO'd relatively recently over the last year or two. So they've had a lot of that new momentum, that new company momentum, helping their shares higher recently, especially these companies doing well in the pandemic. Not today so much, but it will be interesting to see. You were mentioning that other IPO and coming to market news around Airbnb, preferring that traditional route, and Bumble, of course, $6 billion. Who knew? A dating app, Emily.
Who knew? And who's on a dating app in the middle of a pandemic? That's what I want to know. Bloomberg's Abigail Doolittle, thank you so much for joining us. Continuing on this IPO theme, we've got Airbnb, as Abigail mentioned, rebuffing a SPAC offer from Bill Ackman. Palantir getting set up for what is expected to be the biggest public offering since Uber. And now Some buzzing news about Bumble, the dating app. Joining me now with more insight, Ted Smith, Union Square Advisors co-founder and president. Let's start with Airbnb. Ted, what do you make of the fact that Airbnb, continuing to push ahead on this traditional route to IPO, though they did in the past consider a direct listing, and they haven't completely ruled out this Ackman scenario just yet?
Right. First of all, Emily, thanks for having me on. Great pleasure to be with you. I think it's really interesting, and I don't think the final chapter in this story with Airbnb is written yet with respect to how they ultimately come public. I think, obviously, Bill can be a very persuasive guy, and he has the largest SPAC out there today with Tontine. So I think those discussions may continue despite the reports that they've largely broken off at this point since Airbnb filed for a traditional IPO. I also think that last week's news that the SEC approved the New York Stock Exchange to enable direct listings where companies could raise capital may factor into Airbnb's thinking as well, since that's brand new for the direct listing market. So I think my take on Airbnb at this point is, while they have their paperwork in and certainly appear to be on a path to becoming a public company in the near to medium term, I think they're going to keep their options open. And if it turns out that going the SPAC route or going the direct listing route, which can obviously provide some significant advantages for a company, I think they'll continue to consider that until they have to make a single choice.
Let's talk about those advantages. What do you think the benefits of a SPAC would be?
Typically, SPACs can happen a little bit quicker in time relative to a direct IPO. But most traditionally, what has been associated with a SPAC and its advantages are the lack of a first-day trading pop, such that the issuer doesn't leave a lot of money on the table. Obviously, I heard you and Abigail talking about a number of the IPOs that have happened in tech and are expected to happen here. And certainly there are a lot of folks, investors in Silicon Valley, notably Bill Gurley, who've talked a lot about that first day pop and the amount of money that companies leave on the table when stocks ramp up significantly after the first day of trading and weren't able to capture that value for the companies or their selling shareholders themselves. SPACs typically don't see that first day pop. They're all priced at $10 by mechanical design, and oftentimes you'll see them trade up 10 and change up to 11. Now, more recently, given the incredible activity in the market, we actually have seen, even with SPACs, some significant first day pops, but nowhere near what some of the big pops have been associated with traditional IPOs. So a combination of timing and better dialed in pricing have typically been the things that SPACs have offered to companies who want to think about going public that way.
Meantime, you've got news that Bumble could be out of the gate as early as next year. I've been wondering about dating apps in the midst of a pandemic. Obviously, it's more difficult for people to get together in person, but still a potential $6 billion valuation. That surprised me. What's your take on that number?
Well, we've heard numbers from 6 to 8 billion, so obviously don't know anywhere in that range is a tremendous value for the company. I think hats off to the team there. Obviously, that it had helped build Tinder first and moved on to building Bumble. We understand subscriber numbers in the 100 million subscriber range. So I think it's a testament to the fact that the team there has built something that is focused on women and has built a really tremendous and sticky subscriber base. And to your point, look, I'm not using dating apps at all. But the reality in this environment is that electronic connections are taking the place during the pandemic of physical connections. And even though dates look presumably a lot different in this environment than they did 6 to 12 months ago in terms of being able to get together physically, I think it's more about making those connections with people that you're not able to be with in the current environment. And dating sites like this, which allow for those connections, are really replacing the traditional connectivity that we have as human beings. And therefore, I think Bumble is riding the wave of that ability to make connections between people, and is that much more valuable as a result. We're going to have to
do some better user research there, you and me both. Let's talk a little bit about Palantir. Obviously, taking a different route than Airbnb and possibly Bumble as well. What do you make of Palantir's approach thus far?
Yeah, I wasn't surprised necessarily by Palantir's going the direct listing route. I think that's always sort of been talked about and been in the cards for them. And again, I think the SEC's announcement last week that they're okaying the New York Stock Exchange to allow for direct listings, which also come with capital raising. And NASDAQ won't be far behind. They've got their paperwork in for the same thing, only augments that. Now, we understand that Palantir is unlikely to raise capital even in a direct listing. They just raised capital earlier in the summer. They've got plenty on the balance sheet. So again, an approach that allows them to presumably cut down on overall fees necessary to go public and simply allow the shares to begin trading and allow the market to set the value rather than either the owners of a SPAC or their underwriters in a traditional way IPO doesn't surprise me, and I think it appeals to the ethos that Peter Thiel and others have driven in the company. The one thing I do think that is particularly interesting about Palantir, as we've finally gotten to take the cover off of the company a little bit and looking at their paperwork, is the company hasn't been profitable up to this point and is articulating in its filings that it may never be profitable. Now, that's often the case for companies that start out and are not profitable up until the time of their IPO. That's a normal risk factor that you would see in those in the filings. But the point is, the company has engendered some fairly significant losses, and despite its huge name and huge success, particularly in the government sector, I do think it's going to be interesting to watch how investors look at the greater than $500 million loss last year and think about the use of capital for the business and how it can grow and how it will need capital going forward.
So last quick question, Ted. How is it that 2020, a pandemic and economic recession, tens of millions of people out of work, has ended up to be such a hot year for tech IPOs?
I think it's a testament to the fact that there is an enormous amount of capital out there that's looking for some form of yield. Obviously, we've got interest rates that continue to be asymptotic to zero at historic lows, not only here but around the world. Tech, in particular, has obviously been an incredibly hot place to be, in part because of the growth that tech drives, and therefore is viewed to be a way to generate meaningful return, but also because tech is a part of the solution associated with the pandemic. You talked about Zoom with Abigail, and there are a number of other technology companies that have great tailwinds in this current environment because they're able to deliver just this kind of connectivity that you and I are enjoying and others are enjoying in order to run businesses, in order to be with their fellow human beings. And so I think what we're seeing is definitely a hot IPO market, but once again, an IPO market that in many ways is led by tech because of the perception that a combination of great returns and ability to actually help us get through the pandemic until we can get back to a level of normality that we all hope for.
All right. Well, Ted, really appreciate your insights there. Of course, we'll be all over it this fall as these companies start coming out of the gate. Ted Smith, co-founder and president of Union Square Advisors. Coming up, the clock is ticking, tick-tocking. TikTok needs to reach an acquisition deal with a U.S. company or risk being banned in the United States by September 15th. The date is approaching. We will have the latest twist in the TikTok story next. This is Bloomberg. Bloomberg has learned the Trump administration is debating the scope and effective date of its bans on Chinese social media apps, WeChat, and TikTok, and will make its decisions public later this month. For more on this latest development, I want to bring in Bloomberg Kurt Wagner, who covers the company for us. So, Kurt, what exactly does this mean, given that this September 15th date for TikTok to sell to a U.S. company, according to the president, is approaching?
It means that there's still a lot of confusion and a lot of stuff that needs to be figured out because the date is the timeline for when ByteDance needs to sell TikTok, but it's also now a timeline for when Trump is going to make a decision about WeChat, which is, owned by a totally different company. So there's a couple different timelines that are converging here. I think the important thing to know is that most of the companies here are still trying to figure out exactly what this means. And we've now been talking about it for weeks. I mean, even it seems very clear that it's clear that it's unclear whether or not this is going to impact, for example, Apple's ability to do business in China, or if it's simply going to be limited here to the United States. So there's a bunch of stuff that is still being worked out, and I think that that's what we've learned so far today.
Meantime, I feel like a week ago, we were looking at 24 to 48 hours for a deal to be announced, and things seems to have significantly slowed down. Is that your sense? Is it the fact that the Chinese government has said, hey, now we're going to have something to say about this, that, you know, some of these parties might be wondering if a deal's going to happen at all?
I think that's exactly what happened. You and I spoke on Friday, I believe, and I was sitting here saying that I was going to be kind of sitting around over the weekend waiting for a phone call. That obviously did not happen. And what did happen was that the Chinese government said that they now need to be involved in this and basically get approval as well. So now you have the U.S. government and the Chinese government that both need to be appeased for any type of deal to go through. My understanding is that has created a lot of extra hoops to jump through, and that while all the sides are still interested, as far as I know, no one has pulled any bids. Discussions are still happening, but it has definitely slowed things down because now there's a third major party that needs to be, on board with whatever the decision is, and that has created this bit of a delay.
There's also the question of whether TikTok's magic algorithms are actually going to be part of the deal. What is the likeliest outcome here, in your view?
It's hard to predict. I'm starting to lean towards the likeliest outcome being that whoever buys TikTok may have to create their own algorithm for the app. That is part of the Chinese government's kind of new rules. They've come in and said that they need to have approval over any sale of artificial intelligence that would go to another country, which would include TikTok's algorithms here. We know that there is some discussion not only about buying TikTok with the algorithm, buying it without it, but also a discussion about possibly licensing that technology from ByteDance for a certain amount of time. So if you're Microsoft and you ultimately win this bid, could you use ByteDance's technology for a year, for 2 years, while you kind of build up your own? It's unclear, again, whether either or both governments would go for something like that, but I'm told that it is something that is at least being discussed.
So what's timing then on your end? I mean, are you going to be working through the weekend, or are we, a week out, 2 weeks out?
I wish I knew, and I certainly hope I'm not working through the weekend, but I'm getting the sense that this has slowed down somewhat considerably because, again, when you and I were speaking late last week, it was kind of everyone was sitting on pins and needles. I don't get that same sense of urgency from the phone calls that I've been having so far this week. That certainly doesn't mean that it can't happen, but at this point, I think I would almost be more surprised if we get an answer before the weekend than if we do sometime next week.
All right. Well, for your sake, Kurt, I hope you get to enjoy some of it. Bloomberg's Kurt Wagner, thank you, as always, for giving us that update and continuing to chase this story. Coming up, DraftKings is making a draft of its own. We're going to take a look at the newest addition to their board and what it means for the company's strategy. That is next. This is Bloomberg. Former NBA superstar Michael Jordan is putting his bet on the gambling space and DraftKings receiving an equity stake in the company in exchange for becoming a special advisor to DraftKings board of directors. Joining us now with more, Brendan Coden, who covers the company for Bloomberg. So, Brendan, tell us a little bit about, obviously, Jordan, huge. You can't imagine a bigger sports superstar. How involved is he actually going to be in DraftKings?
Yeah, so, I mean, this is the person that's kind of the most iconic spokesperson brand in the world, and he's joining to be an advisor. What that exactly means, I guess, is yet to be seen, but just having Jordan and the Jordan name involved in this is obviously good news for DraftKings, and we saw what happened today with their stock, up 8%.
So what does this actually mean for DraftKings? It's a big vote of confidence from somebody who is really popular. Do you think this could materially change their trajectory?
Well, what I think it means is if you're looking at this from the perspective of, Michael Jordan doesn't need to do things like this, and he doesn't put his name to just anything. I mean, this is someone who has his door knocked on to, advertise different products across the globe. And for him to be willing to do this, I mean, I think it really says something.
And what is the outlook for DraftKings at this moment with, still uncertainty surrounding the return of professional sports? Some have come back in fits and starts. Obviously, that's a huge part of the platform and a lot of uncertainty ahead.
Yeah, I mean, from one perspective, what we've seen and heard from our colleagues in Bloomberg Intelligence is, they're basically priced to perfection right now. The stock has doubled since they, started trading through the reverse merger back in April. So in that sense, I mean, not a lot can go wrong for them to keep up their stock price as it is. But I mean, look, gambling's moving online and people see the opportunity there. So, I mean, the future's bright, but for them to keep their stock price kind of on this, if you will, kind of this insane sort of line, there's not a lot of room for error.
So what's next for the company? I know that they've been getting creative about the kind of activities they'll take bets on. How does that evolve as shelter in place continues in so many parts of the world?
Yeah, I mean, if I had to guess, the big thing in this space, it's just the fight for market share. I mean, you're seeing everyone sort of come out of the woodwork. And, if you pull up a fantasy baseball application right now, you have the chance to do bets. So it's a space that's getting inundated. And I think there's, over this next couple of years, you're just going to see a fight for market share.
All right. Well, that's something I know you and we will continue to cover. Brandon Cock-Coden there, who covers DraftKings for us on the big news of Michael Jordan taking a stake in the company and advising the board. Coming up, how growing up in poverty and violence shaped this mayor's vision for innovative change for his city amidst a pandemic. We're going to hear from Michael Tubbs, the first black mayor of Stockton and the youngest mayor of a major U.S. city. He joins us next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang. At age 26, on the same day President Trump was elected in 2016, Michael Tubbs became the first African-American mayor of his hometown of Stockton, California. That also made him the youngest mayor of a major American city ever. I sat down with Mayor Tubbs earlier to hear more about how the people of his town are coping with the COVID-19 crisis and his thoughts on the controversial gig economy.
I am incredibly proud of the resilience of the folks I get to represent as mayor, although I'm saddened about how often they have to be resilient. We just had the 2008 recession hit Stockton incredibly hard. We were the foreclosure capital of the country for 2 years. Folks had their life savings wiped out, and then we had municipal bankruptcy, where we had folks who lost some of their health care provisions in the retirement package as a result of the restructuring that came from bankruptcy. And now we have COVID-19, this looming depression, recession. So we're hearing it from our folks. Like, folks are stressed and anxious about distance learning and about other kids really getting the education they deserve. They're worried about whether it's safe to go back to work, even though they want to go back to work. They're worried about how to make payroll as a small business and not wanting to lay off the 9 people on their staff that are like family to them, but also willing to make sure they have enough for their families. They're worried about making the rent. There's so many of our folks are essential workers who are in the day camps and migrant workers who weren't given the PPE protection they needed. So it's a lot of anxiety and a lot of a reminder of kind of where we've been in terms of the economics and the economic hardships faced. But I think in a perverse way, because we've been through so many hard times as a community, that there's not a resignation to it, but it's a feeling like, okay, we've done this before and we'll weather it all together.
You've spoken about the gig economy in the past. Uber and Lyft drivers, for example, a lot of people rely on that for extra work, but the work there has plummeted unless you're delivering food. We just did a story at Bloomberg about people hanging smartphones in trees near Amazon warehouses so they can be the first to get contacted about deliveries. What's your view into that kind of desperation?
Yeah, I think that's just so the gig economy to me is so interesting for a variety of reasons. I think on one hand, you want to applaud the innovation. I know Uber and Lyft has made my life easier in many respects. But on the other hand, you have to think about what type of society or country do we live in where folks are working, and then having to drive another 8 hours after work to pay bills? Or what type of society do we live in where folks are willing to work without benefits and without like consistent pay because there's no real other options or there's not a real safety net that will allow them to make other choices. So I'm always torn in discussions about the gig economy, but I think the desperation is real. I think it also puts to rest this notion that people don't want to work, that people don't want to provide, that people don't want to contribute. No, people are super creative and doing all types of things to make money, and not to make money for like luxurious things. Like folks are just paying off debt, paying for private school for their kids, maybe paying for healthcare costs, paying rent, and I think to your point, it just shows just the savage nature in many respects and of our economy, and how, as we rebound from COVID-19, we have to establish some guardrails so that folks are okay, particularly at a time when folks like Jeff Bezos have, in an incredibly short amount of time, have amassed even more wealth, right? And while people are hanging phones outside their warehouses to get a $10 ride.
We just covered a big protest in front of Bezos' mansion in Washington, D.C., where you had Amazon workers calling for a rise in their minimum wage, which is $15. They want $30 an hour. Is that fair?
I haven't seen the economics, but I know D.C. is expensive. But I do think I agree with the point. If in 5 months Jeff Bezos' net worth can improve, I think, $20 billion, that the folks who created his wealth, his workers, should see some of that rise. And they should at least be paid a wage that allows them to pay for necessities like rent and food and housing. And we know $15 an hour in Washington, D.C. is not it. If the number's 30, if the number's 25, there is a number that gets to a place where folks who are creating wealth for someone who's not losing money, he's not hemorrhaging money, he's amassing massive amounts of wealth during this time, should be able to at least provide a baseline level of dignity for the folks who created his wealth.
And do you think that companies like Uber and Lyft, I'm sure you've looked at the California law AB 5 that would require these companies to make workers full-time employees with benefits. Do you think that they should have to do that, which would dramatically change their business models?
Yeah, I think that there has to be a conversation around sort of how do we make sure all workers have the benefits necessary and protections necessary. So I know there's proposals around portable benefits with an understanding that some people want to be independent contractors. For some people, not the majority of people, but there are people who actually enjoy being independent contractors, who enjoy sort of the flexibility of the job, who enjoy coming in when they want, clocking out when they want, et cetera, and not having to work a consistent schedule. So I think the issue is that we have all these folks who are working, who don't have portable benefits, who are sleeping in their Uber cars, who aren't seeing a share of kind of the profits made by their labor, and that there should be some way in which that's reflecting their compensation, particularly around benefits. And if it's portable benefits, that makes a lot of sense. If it's full-time employment, that makes a lot. I think it's just really both Uber, Lyft, drivers, state legislature, and the governor are actually coming to the table with a solutions mindset in terms of this. We could disagree about the solution, but let's agree on the problem and let's work collaboratively to get to a solution that answers the problem we're trying to solve.
A huge theme of the HBO documentary is education as a tool of advancement. You mentioned that with your own education. Obviously, our education system across the country is grappling with great inequities. Some kids don't have access to even the internet, let alone the devices they need to use the internet. What are your biggest concerns at this moment about the future of education and the children of your own community?
My biggest concern is actually about sort of how we're going to mitigate the impacts of the last year, because we know that children's brains are still developing. We know the impact of adverse childhood experiences and how it reverberates 20, 30 years down the line in terms of cortisol levels in the brain, in terms of stress levels, in terms of crimes that are committed, in terms of comorbidities and health issues. And I don't see how being stuck in a house with parents who are stressed and anxious and trying to make sure the bills are met, when school for a lot of our kids, unfortunately, was the one safe place, one place where they could eat, for some kids, a place where they would get their clothes washed, how not having access to that and the socialization from peers, how that's not going to have an impact on their development into adulthood. So I'm incredibly worried and trying to think through as a city, what can we do during COVID, but especially after COVID, to make sure that our babies are okay, that we do everything we can to mitigate the impacts of these adverse childhood experiences that they're experiencing every day during this pandemic. And then on the education front, I think that's compounded with, we already know the research tells us that summer brain drain, that the 3 months stay at home in the summer actually is one of the biggest levers for the achievement gap and one of the biggest levers for educational inequity. That kids can lose a whole entire years of learning by spending 3 months at home in the summer not doing anything. So you compound that with this distance learning thing and all kids not having access to internet. But even if access to the internet, given the housing issues we're seeing in communities across this country, most kids don't have a dedicated, quiet spot to study, particularly if they have relatives who are working from home as well. And then they have brothers and cousins. So just all that chaos, I think that it's going to be a challenge, but it's going to be incumbent on all of us to understand that it's in our best interest as a community, as a collective, to make sure during COVID, but especially after COVID, we provide, even if necessary, extra resources to kids who we know didn't have the same amount of inputs during COVID.
Michael Tubbs there, mayor of Stockton, California, who's also the star of a new HBO documentary, Stockton on My Mind, again on HBO. And just a reminder, Mayor Tubbs is part of the mayor's program put forth by Michael Bloomberg, the founder of Bloomberg LP and Bloomberg Philanthropies and parent company of this network. All right, coming up, more commentary on the red-hot tech IPO scene by one of Wall Street's most respected voices, Kathleen Smith of Renaissance Capital, joins us next. This is Bloomberg. Back to our big tech IPO news today. Airbnb rebuffing a merger offer by activist investor Bill Ackman, choosing the traditional route to IPO instead. Palantir also setting the date of September 9th for its investor presentation. The data mining company pursuing a direct listing. And the dating app Bumble preparing for a public offering that could come at the beginning of next year in the range of $6 to $8 billion by some estimates. For more insight on these stories, we've got one of the most respected IPO voices on Wall Street. That is Kathleen Smith, Renaissance Capital principal and co-founder there. So Kathleen, a lot to digest today. What do you make of the fact that all these companies are getting out of the gate at once?
Well, finally, they're getting out of the gate, and many have already, but this is the first time we're going to see a raft of software companies and a lot of different ways to tap the public market. We have SPACs, we've got direct listings, and then we have regular way IPOs. So I think the important thing is that when investors make good returns on IPOs, that means the IPO market is open for issuance. And you can see from the Renaissance IPO ETF that so far this year, investors are pretty happy in owning newly public companies. It's had very strong returns. And so the market's wide open for issuance. We're about to see finally some of the very large and interesting unicorns tap the market.
So given the environment out there, let's take a look at Airbnb, which is a company that has seen a dramatic impact the pandemic has had on their business, not for the better, though travel is recovering in small ways, but still a long way to go. If you're a company like Airbnb, do you go the traditional IPO route? Do you do a direct listing, or do you consider a SPAC?
Well, I do know there was a rumor about Airbnb maybe being acquired by a SPAC, but it's our understanding Airbnb wants to do a regular way IPO, which I think is probably a good thing. I mean, a regular way IPO has most of the scrutiny and is a pretty successful method for raising capital. I think the challenge for Airbnb is going to be that this most highly valued unicorn is going to have a valuation that's a lot less than what it had at its peak. And it's also, has run into the issues of post-COVID and travel, and its peers aren't doing that well. But I think investors will look beyond that and be really interested in this leading platform. And they've made so many, it's a new economy company that's just, I think, will attract so much attention by investors. So we're all looking forward to this one. I think the IPO will work. It ultimately comes down to how they price it, and I think it'll do just fine.
So are you expecting then Airbnb to take a big valuation haircut as a result of this?
We think that it's going to have to fit into the context of other companies in the travel industry that have taken valuation haircuts themselves. So we think it will. And we'll have to see. We'll have to look at the numbers and study it. But even the private valuations that it's had in recent rounds are far below its $30 billion at its peak. I think it was $18 billion. So we think it will come below its peak valuation.
What's your take on Bumble? Obviously a popular dating app, but dating has been disrupted somewhat by the pandemic, the fact that you can't see each other in person, and yet you've got this company planning to go out of the gate and looking at a $6 to $8 billion valuation, even as the industry itself has been massively put on hold.
Well, in looking at Bumble, certainly if they're not making money, which I don't think they are, we're going to have to look through that and figure it out. But I will point out that Match Group has traded fairly well, and I think Match will be used as a peer here. So I do think that there is a pathway for Bumble to go public. I think the issue is just how to value this company that I'm assuming has large losses.
So how do you think that 2020 will be remembered in sort of the pantheon of IPO years? It's astonishing in a way that, in the middle of a pandemic and an economic recession, we'd see a boom in tech IPOs.
We were pretty surprised, too. We've been managing money in the IPO space for a while. And when we first saw this drop, usually the IPO market takes some time to recover after the drop the market had in March. But instead of really dropping, it actually took off. And that's because so many of the companies that go public are new economy companies. And we have so many software companies that have gone public. I mentioned our largest holding in the ETF is Zoom. Well, there are others too. We've got Slack in there. There's CrowdStrike, Datadog. These are companies that have just fit the time frame that we're in doing virtual business and having companies move to the cloud digital platforms. So the IPO market's sort of in the sweet spot for the kinds of companies that are right for this kind of market. So it did surprise us at first. I mean, I'm happy to see it. And I think that it gives a chance for many of the companies that have stayed private long enough to get some liquidity. And we are in an election year, so we know there's a rush of companies trying to get out now ahead of some of the volatility that'll happen around the election. So this is good news if you're a private company, and to tap the market, there's a lot of interest. They should get going while the getting is good.
So quickly, do you think the game could change as a result or around the timing of the election, and things could get more difficult, more choppy?
You know, with the stock market, the game can pretty much change any time. But our studies, if we look at the history of what's happened, most companies try to avoid tapping the market right ahead of and around the election. So there tends to be a little bit of a dead spot and also more volatility. So our data shows that you get a lighter amount of issuance at the time. I don't know whether this is going to be one of those years that nothing matters and things are good, but I would always say for any company trying to tap the market, you just have to be conservative and realize the market's not always open. I mean, it's been a great market for investors, but as more companies come out and do issuance, the strongest ones come out first off of the bottom. And then we get, investors are throwing money at anything, but we can get a turn. And that'll make it hard for companies to jump on this bandwagon. And we'll get back to a more attractive valuations for investors, not necessarily for issuers. So you never know. The idea is to move forward when you can.
All right. Kathleen Smith there of Renaissance Capital. Thanks so much for your insights. Of course, we'll be following it all in the days and weeks ahead. Thank you. Still ahead, the Duke and Duchess of Sussex are coming to Netflix 6 months after stepping down from their roles as senior British royals. Prince Harry and Meghan Markle are setting out to be Hollywood producers. The details next. This is Bloomberg. Britain's Prince Harry and his wife Meghan Markle have signed a wide-ranging production deal with Netflix, the pair becoming the latest global celebrities on the streaming service's roster. This is Netflix and Amazon spar over streaming rights for blockbuster films. For more, I want to bring in Bloomberg's Lucas Shaw, who covers entertainment for us. So what do you make of the Harry and Meghan deal, Lucas? Now we finally know what they've really been up to.
I think that Netflix is in the process seemingly of signing up every major public figures and political figures from different countries, and I'm just waiting to see, now that they have the Obamas and the royals, who they get next. Compared to most Netflix deals, I mean, we know very little about this. It's a multi-year deal that will span all sorts of different genres, documentaries, reality. We know that Meghan Markle, who of course used to be an actress, is not going to be going back in front of the camera. So it's really, a case of two very famous people who want to kind of lend their name to film and television, getting in bed with the biggest online TV network. It's not like the prince has a lot of experience in this, but his name has real value and cachet for Netflix as it's trying to sell shows everywhere.
Meantime, the question remains when production can restart in earnest, given the halt that the pandemic has put on the entertainment industries. And you also wrote a piece about how Netflix and Amazon are fighting and bidding up the rights to, old reruns and now old, new blockbuster films. What's happening?
Yeah, there are these deals that are called the pay one deal. Sounds very boring, and partially because it is, but they've been the bedrock of the pay cable networks like HBO and Starz and to a lesser extent Showtime over the years. Netflix briefly had a deal with Disney where it got some of their new movies, including The Avengers and a Captain America movie and Moana. And now the deals that Universal and Sony have with HBO and Starz respectively are coming up. They're being renegotiated, and it'll be a very interesting test of both how much money can studios get for these old movies. They're likely worth more than The Office and Friends and South Park combined because you get a bunch of popular movies. And who's going to come out on top? Is it going to be the old dogs in HBO and Starz, or are you going to see Disney with Disney Plus and Hulu, Amazon, Netflix come in and gobble some of these up?
And last quick question. You've got Mulan going direct to streaming, Disney's remake of it this weekend. Very excited kids here in my house about that, but a big deal given that this was supposed to be a big hit in theaters. It got pushed back, and now finally Disney has said it's going out on Disney+.
A huge test of this new premium video on demand model where you can pay a little extra at home to watch it instead of, say, going to the theater. I spoke with the producer of the movie this afternoon. He's very optimistic. He thinks that's a good price point. I don't know because we don't have any experience with something like this, but it'll be interesting to watch because Mulan will be going in theaters in a lot of countries and then be available at home in the U.S.
All right, close to $30 you have to pay for it, but I'm sure there are some desperate parents out there to get some fresh content in front of their kids. Bloomberg's Lucas Shaw, thank you so much for that update. We'll, of course, be watching to see how Mulan does this weekend. And that does it for this edition of Bloomberg Technology. I'm Emily Chang. Bloomberg Daybreak Australia is next. This is Bloomberg.